for being here. I appreciate your patience changing the room over from this morning's session. We have refreshments over here. We want to thank Lisko Family Amusements for providing those. So when you see the Lisko family, make sure you say thank you. That's a very generous sponsorship on their behalf. We passed around Tiffany's slides. Where you can record some notes. Thank you, Linda. Thank you, Michelle. Also, your training certificate. You want to keep that in your file. Sometimes the auditors will come and say, have you had any continuing education? General continuing education is not a mandatory requirement. It should get your audit off to a nice start when they ask you to have something. So I think many of you know Tiffany Rankin. She's a CPA. She's also the newly elected president of the Delaware County Ag Society. And she's going to be our presenter this morning. Tiffany was on last winter talking about the CARES Act and some other important things to what was going on with fairs and money when we did the online presentations, and we appreciate her doing that. We appreciate her being here today. She's going to try to bring us up on some PPP, some other things, some other stuff going on with COVID and stuff, things that are hanging out there, and some other accounting and bookkeeping updates. And she plans on sharing ideas for receiving. We asked her to do this stock as a charitable contribution. This is becoming more and more popular. So there's a way to do that. She's going to talk briefly about that. And there hasn't been much coming up, but we did have it on the list to talk about newly things coming out of Washington. And that's kind of lagging right now, I understand. But Tiffany spent much of her career working in tax-related matters, including research and tax planning, pass-through entity taxation, sales and use tax, controversies, and I think many of us know about that. She has serviced clients in the real estate, construction, manufacturing, professional service, and entertainment fields, and she has experience representing clients before IRS and state taxing authorities. So it's my pleasure and really our good fortune here to have Tiffany as one of ours and be here presenting to us today. So how about a warm welcome for her?
Well, hi, can everyone hear me okay? I probably don't even need a microphone because I'm loud in general, but we'll go with that. So as Bob said, my name is Tiffany Rankin. Thank you again for having me. I'm glad we're back in person as much as we can be. A little background, like I said with me, I've been on the Fair Board, Ardell Ag Fair Board for, I don't know, 5 years now maybe. And in our recent election, I was the newly elected Fair Board president. So I'm second month of that under my belt, and lots of exciting things going on there. If you didn't get to come to, if you haven't been out to our grounds, you should come. We've opened up a beautiful new building for our fair this year, compliments of our bed tax money that we get to have. So you should come and check it out. It's pretty great. I'm a CPA by profession, and I've done it for 20 years. And recently started my own firm a couple of months ago called the TLA Group. And coincidentally, my office is housed at our fairgrounds in the log cabin at the racetrack. So I get to be out there all day, every day, which is great. So what I'm going to be presenting on today, so that you guys can get your certificate, is going to be an overview of, the last 2 years for the most part for all of us, and every fair, every person in here, their ag society has been affected by this in one way, shape, or another. We're going to go over just a high-level overview of the Paycheck Protection Program, PPP, just very high level. The Employee Retention Tax Credit. That one I don't think I talked much about last year because it wasn't much, I don't think I talked much about it last year. For those fairs that don't have people on payroll, this will be boring to you maybe because you need to have people on payroll. But if you are a fair that does put people on payroll, we're going to spend a little bit of time on this section because it's easy money to get back to your fair if you haven't gotten it. I mean, we've applied for 6 figures worth of it. We haven't gotten it all yet, but it's really beneficial. And if you have employees, in theory, you should all qualify for it. So we'll spend a little bit of time on that. We're going to briefly go over the Economic Injury Disaster Loan, the EIDL. I don't know if originally that wasn't available for agricultural entities. It is now. So we'll just go over that and see what fairs got that and questions around that, accounting for that. We're going to quickly quickly talk about the various ODA grants that we all received. What I would like, and again, this is an hour and a half, and since there's nothing really coming out of Washington right now, crowd participation is encouraged. If there are questions, raise your hand. This is being taped so that people can watch it later, so we encourage questions. But with the ODA, I know of the grants that we've received and we've gotten, so certainly if there are ones that I'm not gonna mention here that you have received with your group, maybe bring that to light, because if it's available, we should all be able to benefit from those things, because we were all kind of in the same boat the last 2 years. Then from there, after we go over the overview, I'll briefly talk about how to account for these things and the associated footnotes that need to go with the COVID-related matters. A lot of the things that we do at our fair, we report on the GAAP basis financials for ours, so a lot of the things that we have on ours are not applicable to you, so I'm not really gonna go through a bunch of them. What we will go over are what you would need to have on your ODA, how to report those things, I believe, for your ODA report that you have to turn in tomorrow. Coincidentally, there's an ODA forms session tomorrow afternoon, so I'm gonna go to that tomorrow to make sure that what I told you today is accurate. If it's not, I'll get it to Bob and we'll do a corrective follow-up. Then the third bullet here, and I forget what county we did this, the question came up with the receipt of stock as a charitable donation. I can't remember the county, but that issue was posed to me, I don't know, in the last year, and we walked through how to facilitate that, and it's really a terrific way and becoming a very popular way for nonprofit organizations to receive an asset that they can either keep or turn into cash. So we'll go over that and the practical nature and how that can be handled and how you can maybe adopt that as a revenue stream into your fair. And then the last bullet is the tax reform updates from Washington. There's really nothing there. I'll hit on it briefly, but it's not gonna provide us with much content. So let's get started. The first area we're gonna go through is the Paycheck Protection Program, high level. So by a show of hands, what county fairs were able to receive applied for and received either round 1 and or round 2 of PPP monies? Okay, good, great. And in that same show of hands, was anybody's on initially over $150,000? Okay, I didn't think so. Okay, so because the ability to get your loan forgiven is a piece of cake. It's almost a joke if it's under $150,000. So if we're all under that, I can keep it at that, and we'll go from there. I know we did ours. We got about $77,000 on ours, and ours is one of the larger fairs. So I figured we would all be under $150,000, but I just wanted to ask. So basically, the backbone of the PPP, as pretty much you all know, it came about last March, round 1 of it through the CARES Act. The intent of getting that was to keep your people on payroll, to pay for utilities, to pay for rent. Most largely, it was to pay for payroll. And so you got that money. The calculation for it was a multiple of your payroll. So you received the funds. As long as you spent that on what they told you to spend it on, it gets forgiven. You don't have to pay it back. It is an income to you. Now, quite frankly, from a tax exempt standpoint, like our fairs are, even if it was taxable, we wouldn't pay tax on it. But just in general terms, it was like you got your cake and you got to eat it too. You applied for it if you qualified. You received the money as long as you spent it on what you needed to spend it on in your period of time. Then you could ask for forgiveness and get that. So that was in the CARES Act. That was round 1. Then at the end of 2020, December 27th to be exact, the Consolidated Appropriations Act, CAA, came into play, and that provided really beneficial things that we'll go into that was probably the best, the CAA was the best act, in my opinion, out of any of the acts. What that provided for is round 2 of funding, and so basically for all of us that got round 1, if we got under $150,000, which we all have said that we did, we didn't even have to demonstrate we all knew that we needed it. Every fair did, I think. But we didn't even have to necessarily demonstrate that we did. If we were requesting under $150,000, we could just go back and do the same thing and get the same amount of money. So did most of you go back and get round 2? Okay, great. So that's excellent. And so the same rules applied there. You had a certain period of time. You needed to spend it on certain things. And then you could go and ask for forgiveness. It's a 1 sheet of paper. 3 questions, you sign your name, and boom, you're done, and it gets forgiven. So by now, round 1, as far as forgiveness goes, the timeline with that is you pick your covered period, 8 to 24 weeks, or anywhere in between, from the date of your, whatever your ending period was. Let's say it was October 31st of 20. You had 10 months from that point to ask for forgiveness. So basically what that means, if you haven't asked for forgiveness for round 1, you've missed your window and you're gonna have to pay it back. So hopefully everybody has gotten forgiveness on round 1. If you haven't, I'm not asking for show of hands on that one, but if you haven't, you have missed your window for round 1 and you will need to pay that back. Round 2, we're in the middle of round 2 now. So if you got round 2 of funding, you would have received that at some point in 2021. And then you pick your period of time, 8 to 24 weeks, of which you want to spend that on. When your period is over, then your 10-month clock starts again. So what that means is any of us that got round 2 of funding, we are well within our window, 10-month window, for the most part, to ask for forgiveness. But your clock is ticking. And again, all of us are under 150, so it's a 1-page document. I mean, it literally should take you 30 minutes, if that. And so then the last bullet point that I want to talk about here quickly, the coordination with other COVID benefits. Originally in the CARES Act, the coordination effort wasn't really that big of a deal because in the CARES Act it said, if you got this, you couldn't get this. If you did this, you couldn't do this. And so everything was somewhat siloed. When the Consolidated Appropriations Act came in at the end of 2020, it did a lot of things, but one of the big things that it said, which is what we'll go into next, is if you did, you can do all these things. You can now retroactively go back and apply for these things, receive these things, expand these things, and they can all work together. But the concept that I will continue to harp on or reiterate here, and it's a concept that is very important as we go through the rest of it. All of these provisions that I'm going to be talking about outside of the ODA grant, all of the provisions that I'm talking about really relate to payroll wage dollars, keeping your people on payroll. I mean, you're allowed to spend it on other things as well, but the culmination of working together through all of these programs, it's all about wage dollars. So your $1 of wage can only be touched once. If you touch it and you use it for PPP, you can't touch it for the other things. It can't be tainted twice. It can only be tainted once. So as we go through this, keep that in mind that if you've touched your dollar of wage with one thing, an orange, you can't go touch it with an apple. You can only touch it once. Okay, so the next one I want to talk about, which this one is like, it's stupid money. If you qualify for this, the amount of money that you can receive from this is maybe not so much at the Ag Society level because our payroll isn't that significant, but for our size organizations it could be. I mean, quite frankly, it's a lot of money that, because of the fact that we weren't able to have fairs or our fairs had to be modified, we qualify for. So what this is called is the Employee Retention Tax Credit. Originally when COVID started, this did not get a lot of play. I didn't emphasize it very much because originally it said if you get PPP money, you cannot get ERTC money. You can do one or the other. And so mathematically speaking, you got more bang for your buck doing PPP, and that's what everybody did. So this ERTC, I mean, forget about it. None of us did it. Well, then the Consolidated Appropriations Act came back through at the end of December, and they had a change of heart, and they said, we're changing our mind. If you did PPP, you can still do ERTC, but again, your dollar can only be touched once. And so there was a lot of discussion back and forth about that, but this was huge, knowing that you could retroactively go back from the beginning of COVID and recoup more dollars. And so let's talk about what it is. So the ERTC is a refundable credit based on employee wages paid during a qualifying period. And we'll talk about what a qualifying period is. The maximum credit that you could receive in 2020 was $5,000 per employee. And when I say credit equates to cash. So credit is literally going to be a deposit into your checking account. It's not a deduction, but it's actual. It will be actual cash. It comes off of your payroll form. You get it via filing of your payroll forms. So in 2020, the maximum amount that you could get was $5,000 per employee. In 2021, in 2021, that significantly got expanded. And based on your level of payroll, it's possible, if you qualify, that you could get a credit or cash of $21,000 per employee. So if you just in your head do the math, that can be significant money. And we'll give an example. There's examples of that. And it's real money, especially if you're not able to generate revenue because you're shut down. And so with that, we can retroactively go back and do it at the start of COVID. So that would be middle of March of 2020. And it's a quarterly thing. I know we're all fiscal year end November 30th, but the concept of this is calendar because it's tied to wages. So we need to, when we think about if we're going to qualify or not, we have to think about it in a calendar quarter, not our fiscal year quarter. So the time period that we can go and now look at this is March of 2020 through September 30th of 2021. The one thing that did come out of Washington a couple weeks ago was the Infrastructure Investment and Jobs Act. And that said this was supposed to go through the fourth quarter of 2021. But that came in and they had a change of heart, and so it got repealed for the fourth quarter of 2021. So even if you thought you were going to qualify for the fourth quarter that we just ended, that got repealed in that act, and you will not qualify for that. And like I said, the key here was that originally under the CARES Act, you could do one or the other, PPP or ERTC. Pretty much everybody did PPP. CARES Act came in and said you can go ahead and go back and do both as long as you don't touch, as long as your dollar stays whatever bucket you're going to put it in. And that might not seem important, but as we go through how we're substantiating how we've spent our money, it really becomes critical to maximize both the PPP forgiveness and the retention credit that you could receive. Okay, so the eligibility requirements for 2020. So if you think back about 2020, there are two ways to qualify here. One of them is that you are partially or fully or partially suspending commerce or operations because of a government order. So every single one of us in here was affected by this for all of 2020 because we were not, I know some of us, whatever variation of a fare that we did or did not have, I don't care who it was, everybody's was modified. So that in and of itself, every single one of us, our organizations qualify in 2020 because we were fully or partially suspended based on a government order. And, but let's say that we weren't. The other way to qualify is if you look at, you had more than a 50% decline in revenue in a calendar quarter in 20 compared to that same quarter in 19. So if you take second quarter of 20, take the, well, I guess our fair is third quarter, but whatever, just think about whatever quarter your fare is in and compare that to that revenue, because you didn't have a fare maybe, and you compare that to your revenue from your fare in 19. It's a no-brainer that you're probably going to have more than a 50% reduction in revenue. So if you didn't qualify under the partially or fully suspended provision, again, which we all did, you can also go to this one and see if you qualify. So in 2020, it doesn't say this here, but how it works is if you qualify in a quarter, you automatically get a bonus quarter. So if you qualified in the second quarter of 2020, even if you didn't qualify in the third quarter of 2020, they're giving you a bonus quarter and they're letting you have it anyway. And then you look at the third quarter, and if you didn't qualify in the third quarter, you don't get to move forward. But in 2020, the first quarter you qualify in, you get a bonus quarter. And if you qualify again, you get another bonus. It's like a slot machine. So if you qualify, it's in practical application for our ag societies, we would qualify second, third, and fourth quarter for 2020 because we were all partially shut down. And so then that was at the end of 20. So we start over then in 2021. The provisions for 2021 are the same as far as partially or fully suspended. So I think for our fair, and our treasurer Dan is here, I think we decided that we were no longer partially shut down sometime in May. I think there was a point that where we decided that we're allowed to have our fair, and pretty much other than wearing masks and those things, people were allowed to be on, number of people were back to normal. So we decided at some point in May, I forget which, May of 21, that we were no longer, there wasn't that government order to affect our business anymore. So then what we did, we are now going, so that's off the table. So now we go to the second choice of, do we qualify from a revenue standpoint? And the criteria for that is more favorable than it was in 2020. In 2021, you only have to have more than a 20% reduction in revenue, not 50%. So you would compare your revenue in a quarter in 2021, so say first quarter of 2021, you compare that to 19. We act as if 2020 was not a thing, because we don't compare anything to 2020 because it's not a good comparison, because everything was so off. So if you want to look to see if you qualify because you maybe weren't shut down, you look at your calendar quarter revenue in 21 and compare it to that same quarter in 19. All you have to have is more than a 20%, not a 50% reduction in your revenue, and you will continue to qualify to receive this credit. There's a special rule with 2021. You don't get the bonus quarter like you did in 20, but in 21, if you look at your quarters and you didn't quite get it, you can go pick another quarter and see if you can get it there. I don't know. So they're just giving you stuff all around. So let's go into an example, or no, what are we doing next? What is the credit based on?
Question.
Yes.
Me?
Oh, hi, yes.
Hi. So, for comparison, we can use any quarter we want in that year?
Okay, so the question out here is, if we want to, I'm doing this for the
Sure.
the videoing. If we want to do comparatives from one quarter to the next to see if we qualify, you would look at whatever quarter you choose to look at. You need to do that same quarter in the 2019 year.
But for 2021, we
Oh.
can choose any quarter to look back?
No, sorry, you can go back one quarter. So for the special election for that, if you look at your first quarter of 21 and you compare it to the first quarter of 19, and it doesn't get you there, right? Your reduction is not there. You can go and choose to look at the fourth quarter of 20 compared to the quarter one of 19. Yeah, you can go back one quarter. Sorry.
First quarter.
Yeah. So or if you look at the second quarter of 21 and you compare it to the second quarter of 19 and you don't get there because you didn't have the right reduction, you can back up one quarter and look at the first quarter of 21 compared to the second quarter of 19.
Oh, so you can choose a quarter in 2021 to start looking?
Yeah.
That's what
Oh,
I'm
I'm sorry. Yes, you can.
So you don't have to choose the quarter your fair was in, you can choose any quarter?
Yes.
Okay.
Yeah, and so what I would say, what I would caution on that, when you're looking at revenue, make sure you have your revenue in your right periods. A lot of times we don't necessarily, obviously a lot of our revenue is gonna come in the quarter of our fair, but just when you do the calculation, make sure that you're really comparing apples to apples. And there are some, and I'm not going into detail about all, we can talk about this afterwards, and my contact info is there. There are some sources of revenue that may or may not have to count. General operations of your fair, those are all going to count, but there are some special provisions in there, and I can't remember them off the top of my head, that may or may not be able to be excluded.
Well, I'm just thinking about our building rentals that we couldn't
Yeah.
reduce, like first quarter or second
Oh, yeah.
quarter.
Yeah.
Okay,
Yeah.
that's what I was.
Yeah. Okay, so what is the credit? So as I said, it's a percentage of wages. So for your ag societies, if you don't have payroll, I'm really sorry that this is probably boring, but you will get your certificate. But this concept still applies out in the non-ag world as well. So in 2020, the credit is 50% of qualified wages. You can throw health care and retirement benefits in there, but I don't know if any of us have that. So let's just stick with wages. For 2020, it's 50% of your qualified wages. And if you remember, I said it's up to $10,000. The maximum credit is $5,000 per employee per year in 2020. So that's a max of $10,000 of wage per employee per year. So 10,000 times 50% is $5,000. That's the max credit you can receive per employee in 20. In 21, it significantly gets expanded. The credit goes up to 70% of wages versus 50, and now it is $10,000 per employee per quarter. So it like it more than quadruples if you qualify. And the math here, I mean, this is on a smaller scale, but mathematically, it's a significant amount of money if you qualify. Now, and again, remember, if you touched your wage dollar with PPP, your wage dollar that went towards PPP cannot be used for ERTC. So we'll get to one of those examples at the end where we might need to go and do a little homework and a little white paper detail so that we can substantiate getting our money. Okay, so here's the example for 2020. And I'm using the revenue decline in these examples because, as I stated before, we all qualified under partial shutdown. So I'm just using the other option just for illustration. So your Ag Society in 2020 had a 20% decline in gross receipts for the second quarter of 20 compared to that same quarter in 19. So A, we qualify. We qualify in the second quarter. And remember what I said about 2020. If you qualify in one quarter, you get a bonus quarter. So right off the bat, for no other reason, you get quarter 3 as well. Then we look at quarter 3. In quarter 3, you only had a 15% decline in your gross receipts in quarter 3 of 20 compared to 19. So we look at that, and you don't qualify in the third quarter. The only reason you're getting the third quarter is because you get the bonus. But since you didn't qualify in the third quarter, you don't get the bonus for the fourth quarter. I know that that's confusing, and we can talk about it later, but you look at it and you decide what quarters you qualify. In this case then, our organization had 2 employees, Jen and Thomas. Quarter 2, their quarter 2 wages are listed there, $3,900 and $11,700. Their quarter 3 wages are listed there. For total wages then, for the 2 qualifying periods, for Jen of $10,400 and Thomas $31,200. Now remember what we said on the slide before. In 2020, you're limited to $10,000 per employee per year. So both of their wages were higher than that, so we have to cap both of them at $10,000. At a 50% credit, your Ag Society will receive a $10,000 refund for the wages that you paid to those 2 employees. And the way that gets facilitated is amending your payroll tax returns and getting it back that way. I will tell you, if you go and do that, it's going to take a while for you to get your money because the stack of these is like taller than this building that the IRS has received. But you will eventually get it, and they will pay interest on it. So let's move to the example then for 2021. In 2021, the rules have changed a little bit. Our Ag Society had a 30% decline in gross receipts from quarter 2 of 21 compared to quarter 2 of 19. Remember, we forget that 20 is a year. So the hurdle there to qualify is that you had more than a 20% reduction in revenue, not 50. So you qualify in quarter 2 of 2021. In quarter 3 of 2021, you got by the skin of your teeth. You had a 21% decline. You barely did it. You're probably going to want to check your math just to make sure you got it. But you had more than a 20% decline in gross receipts in quarter 3 of 21 compared to quarter 3 of 19. So you qualify as well. So we're going to go back to the same example for quarter 2 and quarter 3 of wages. Remembering that it's a 70% credit and it's $10,000 per employee per quarter now. So the total wages paid to our same 2 employees in 21 were $14,500 for Jen and $31,200 for Thomas. And so remember, the maximum is $10,000 per quarter. We have 2 quarters, so that's $20,000 max wages per employee. So we're going to be able to use all of Jen's wages at $14,500. Thomas's wages are at $31,200, but we have to cap it at 20. So we can use $20,000 of his wages. So in total, we get to use $34,500 of wages at a 70% credit, which will get your Ag Society a little over $24,000 in cash, just for keeping your people on payroll. So if this is something that you will qualify for and you haven't taken advantage of it, The statute of limitation, there's a 3-year statute, so there is plenty of time to do it. And I would highly encourage you going back and doing some work on this to try and get this money, because, I mean, it's there, and it's free money. Okay, so as I said, this is retroactive back to the beginning of COVID, which is March 12th of 2020. And now, this is kind of where the interaction of all these things come into play. You can do it back to, March 20th of 2020 through September 30th of 2021. But now, again, what really is important here is when most people, prior to the Consolidated Appropriations Act, which was at the end of December of 2020, so this is, and I'm not gonna use any profanity up here because we're getting taped, but this little part was pretty crappy. So, at the end, I would have said something else, but all along, people were getting their first round of PPP money in 2020, and by December 27th, when this new law came into place, a lot of people had spent their money and already gotten forgiveness. I mean, a lot of people did that. And then the Congress came in and said, well, now you can go back and do ERTC. But again, you can only touch your dollar wage one time. Well, people were saying, well, we already applied for forgiveness, and we didn't screw around. You know, the requirement was 60% of your PPP had to be used for payroll, 40% had to be used for other stuff. Well, most people were like, screw that, I'm just gonna use 100% of my payroll to substantiate my PPP. Easy, no big deal. I'm not messing around with anything else. Well, that sounds great until you come to this December law, which says, well, you can't touch your same dollar for PPP and ERTC. Now, in practical application, what I will tell you, for all of us, because we were under $150,000, we didn't have to provide any substantiation. And so I think that there's the ability, you can go back and take a look at your qualifying expenses during your periods and look at it and say, this is how much, at a minimum you want to allocate 60% of your wages to your PPP, because that's the requirement. If you don't allocate 60% to your PPP, you're gonna have to pay some of it back. So you wanna put 60% of your wages to your PPP, and whatever then is left over, if it falls into a quarter that you qualify for, throw that money towards your employee retention tax credit. Use those wage dollars to go and do the tables that we had up to get some refunds. It does take a little bit of work, but I will tell you, it took us a couple hours to do it, but we've applied for well into the 6 figures, because it's just, mathematically speaking, it's a lot of money. I mean, it's just simple math, and it's a lot. So I do think it is well worth your effort, your time and effort, to either you look into it or have somebody do that for you. Any questions about that? If it's a specific question for your Ag Society, I can address that afterwards. Yes, in the back.
So my question is how? How do you do it? You're just saying.
Oh, how do you do it?
But like, let's say he never did it, and now you're telling us it's great, we should do it. Okay.
How to do it? Yeah, that would help, wouldn't it? So the question is, which I didn't address, is, well, how do you do this? Yeah, it's a good question. So you figure, so the answer to that really is, you figure out what you qualify for, right? And then you get your payroll reports by employee, and you do your calculation, and I have a spreadsheet, I have to find it, but I can get it to you. And you come up with your answer on your qualifying wages. The way that you go about doing that for 2020 and 2021, now that we're in 2022, so nothing is in live time right now, you would go back and you would amend your quarterly payroll returns, so your Form 941. They've been revamped to address this, and it's a little cumbersome to do, to be quite honest. I would, if you have your payroll company do that, I'm sorry if you work at a payroll company, but they charge quite a bit of money. You would be better served to try and do it, find someone to help you with it. A lot of the services are charging a flat rate to do it for you based on the findings, and you can get it done cheaper than that. But you figure out, you calculate it, you figure out your eligible wages, what quarter that falls in, and then you go and you file an amended Form for those applicable quarters and work through the calculation, and there are lines for that now, and you send that in. And then you wait. So, we did it, that's what we did for 2020, and I think, but then in 2021, because we did it as it was going, we accounted for that in the actual filing of our original 941. We didn't have to go back and amend those, but we did for 2020. Okay, so the next one that I'm only going to talk about, if I know we got this, I want to see if anybody else, any other societies did. Did anybody else apply for and get the Economic Injury Disaster Loan, the EIDL? Okay, good. So originally, I don't know when this changed, some point in 2020. Originally, agricultural entities did not qualify for this. Historically speaking, the SBA, for whatever reason, has never lent money to agricultural entities. I don't know why, but that has changed. And so at some point in 2020, they came back and said that agricultural entities can now qualify for this Economic Injury Disaster Loan. So you're like, well, what is that? So there are no new, if you're excited because you're an ag society and you qualify, that's great, but they're not accepting new applications. So that door has kind of been shut. But if you did get one, what it is, it's a 30-year loan, low rate loan that was meant to provide working capital money to your organization to get you through COVID until normal operations could resume. Like I said, agricultural entities of all kinds were prohibited from doing this until at some point in 2020. They're not accepting new applications, but one of the law changes came in. The cap for the loan used to be at about $500,000. It's not guaranteed you get that, but that was the cap. When they came in and allowed agricultural entities to participate in this, they extended or they increased the limit to $2 million. So if you haven't applied, you can't go and apply. But if you have a current loan out there, the SBA is willing to revisit the application, the current loans, and expand your loan amount if you qualify. So if you've got one and you feel there might be basis to get more, you can go back and work with them and see if your loan, if you can get more money. Now this at the moment, this needs to be repaid. So it's a 30-year loan. For nonprofit entities, which we are, your rate is 2.75% interest rate, so cheap money. For for-profit entities, it's 3.75%. So 30-year low interest rate loan. They put into play the deferral of the two-year deferral of payments. So you have an amortization schedule and interest is accruing the entire time, but the payments don't need to start until 2022. So if you got your money in 2020, you got a 24-month deferral to start paying. If you got your money in 2021, you have an 18-month deferral to start paying. We joke at ours, we've been trying to pay, but nobody will accept it. We've been trying to make payments, and the SBA, right, Dan? The SBA.
I've talked to them twice, they're not even ready to start looking at it.
Yeah.
I asked the lady on the phone in San Antonio if we want to forget it. She didn't answer me, so they're not ready to start looking at these until June or July.
Yeah, so if you got this and you're concerned that you need to start making payments, don't worry too much, because unless, I don't know if anybody else has had luck making payments, but we've tried and they're not taking them yet. So, but the interest does accrue on the loan from the date that you received it. So, but also we say, well, who knows? Maybe at some point they'll just forgive this whole thing too. I mean, we don't know, so we'll see. So that is the EIDL. And lastly, the two others that I want to talk about, I don't have a slide in here for that. So the ODA grants, we all know that we got $50,000 per year to help with either junior fair or PPE or any of those things. Those are grants. They're not, we don't have to repay them or anything. Are there any other ones from the ODA that anybody got that are outside of those two?
They removed the matching too on that.
Oh, that's right. You removed the matching. That's right.
That wasn't COVID money.
The 50,000.
The first 50,000 was capital money, it wasn't COVID money, it was the one that the match was eliminated.
Oh, right, but
The
that.
second was 50,000 if you had a junior fair, and something else if you had just nothing, you got a payment. And then we had last year around fair time, there was a 3,500 or
Oh, yeah, that one,
3,400.
that's right, yeah, okay.
Just about
Yeah.
40, or 39,000.
Okay, that's, okay, so
Or
those,
59,000.
okay, so those, we're aware of all those, okay, good. And the one that Bob asked me to bring up, just because it was brought up in another section, that I mentioned when I did this about a year ago, there's another thing out there called the Shuttered Venue Operations Grant. And that one is actually that one's geared towards the entertainment industry, so if you think about concert halls, movie theaters, those are really the big ones. Sporting, like, Browns or Cavs or any of those, that basically the premise or the business purpose is that they sell tickets and they bring people in to view entertainment. It's an entertainment venue. And so we went round and round and round, and I'm not gonna go into all the details of it because I don't remember them off the top of my head, but it can be significant money if you qualify. So for the past quite a few months when this first came out, we spent significant time working with our legislative people to try to determine if fairs qualify, because we sell admission, we sell tickets, there are, depending on what you have going at your fair, you in theory could qualify for this. We got a determination, we got something back, I can't remember from who, but basically it said that fairs did not qualify for Shuttered.
I sent it in 3 times, and they actually turned us down in the end because we had an event. Even though we didn't have people there, we had racing, we had ticket sales of some kind, and we had income from gambling. So that's why they turned us down the 3rd time.
Yeah,
First
so-
they told us we didn't qualify, so I sent it back in. They sent it back again saying we didn't qualify, and then the 3rd time they sent it in because we had a fair, even though we didn't have people there. We did have a horse race, we did have
Yeah,
the fair, and that's why they finally turned it down the 3rd time, and I didn't go back.
yeah,
One
but
other fair, Putnam County, I think, was the only fair in Ohio to get one.
Yeah,
the
what
one I
county did you
talked
say?
to.
Mercer County, so is that you?
Got one in Allen.
You did, how did you get it?
Some jobs got it too.
Really?
Yeah.
I mean, I'm curious, so, because the requirements, I mean, they're pretty specific requirements in it, how did you get it? How did you qualify? I'm just curious.
I'm not the one that applied.
Okay.
For it, but I do know that they kicked it back and resubmitted it like 3 times.
Okay,
So, but,
okay.
yeah, I don't know the specifics.
That's okay, I was just more I mean, it's over, the money's gone now, so I was just more curious that, in the back.
I submitted it, I don't know, I put in all the stuff they asked for, I didn't have to do anything. They just-
Huh.
Okay.
Well, Well, anyway, good for you. We're not covering, I didn't cover how to report for that in your finances, so, go to that thing tomorrow and ask them where you need to put that on your report that you've already turned in. Okay, all right, and so then now let's talk about the accounting for that. So as I'm gonna tell, the first couple I know they're right, because there was guidance on that. The bottom 2, they may or may not apply to you. This is where I think they go. Like I said, I'm going to that tomorrow and I'm gonna ask that, and if I'm wrong, I will correct myself and I will let you know that I'm wrong. So the first one, the monies that were received from the Ohio Department of Agriculture, I don't know, we talk about our stuff going to the auditor of state or the ODA. Ours are 2 very separate things, so that's how I've broken them out here, but this slide is meant towards all of you who do cash receipt and disbursement basis. So the headings and where they need to go are what you would need to do. I just broke them out separately because we send ours in separately. So the ODA report that is due tomorrow, the grant the monies that you got from the ODA, let me check my time here to make sure I'm doing it on time. 1 second. Okay, I'm good. The monies that you got from the ODA, those go, on your spreadsheet thing that you have to turn in. That's gonna go under account number 3190, which is other restricted support. So it's in the restricted section, the 3190. And you have the 2 columns where you have your operating money and you have your state and local money. This needs to stay in the operating money. The ODA money does not go, even though it came from the state of Ohio, it was a federal program, so it needs to stay in the operating column. It does not go in the state and local column. Again, it's 3190, other support restricted. And the reason it's restricted was because they told us basically what we can spend it on. On your auditor of state report, so your cash receipt and disbursement report, this ODA money is gonna go under non-operating receipts as your donations contribution section. So it's gonna go like 2/3 of the way down the page on your cash receipt and your disbursement section. If you receive PPP money, that money on your ODA report is also gonna go in account 3190, other support restricted. Again, the reason it's restricted is because it gave you specifics on what you could spend it on. It wasn't a free-for-all. And that too is gonna stay in your operating column. That isn't gonna go over to your state and local column because that came from federal money. Now, so I know those two are right because I don't know if it was, I forget who put on the Zoom about it last year, telling us where to put it. But the next two, was that ODA?
Auditor of state was here.
OFMA.
OFMA, okay.
Last year was it.
Yeah, okay. So the next two, this is what I think, and these are the ones that I'll solidify tomorrow. If you have received the ERTC, or in the future if you're going to get it, on your ODA report, we have put that for ours under account 3290, other support unrestricted, because that money, when you get it back, you can do whatever you want with it. There are no restrictions on how to use that money. So when you do your ODA report, it's account 3290, other support, but unrestricted. I did scratch that non-operating. I don't know why that's there. It needs to stay in your operating column. It doesn't go over to your state and local column. I don't know why I said non-operating. Just disregard that. On your auditor of state report, we have currently put that under operating receipts, other operating receipts, because it's in theory, getting this money back for ERTC is a direct reduction of your payroll. So if you paid $100,000, you're going to get 30 of it back. So that's a function of operations. So and again, this is what I'm going to clarify. But for now, we have put ours on our report that we will submit to Hinkles through the Hinkles system. We have put that money under operating receipts in the operating section of the cash. You'll put that in your operating section of your cash receipts and disbursements under other operating receipts. You possibly could net it with salaries, but I wouldn't. I would show them out because it was actual money coming in. So I would not aggregate those together. I would not net those together. If you receive the EIDL loan, the proceeds, on your ODA report, that's going to go under code 3800 under mortgage. So that's proceeds from a mortgage. So that's where you would put that. You would put that there. Under your auditor of state report that goes through Hinkles, you will put those proceeds under non-operating receipts under mortgage income. So for those of you that have those things, those I believe are the proper reportage on how you need to account for those. Yes, in the back.
So what if you have already turned them in and you get one of these wrong? Like, is there a way to go back in?
That's a good question. So the question is, well, shoot, what if I already turned this in if it's wrong? I don't know the answer to that, but I have a list of questions for tomorrow. So again, there's an ODA forms session. I think it's at, I don't know, sometime in the afternoon tomorrow. I don't know the answer to that. I would hope you could go back and fix it. I know in the Hinkle system, they're pretty strict with the auditor of state. I don't know, and we haven't been with the auditor of state lately yet for ours, so I don't know the answer. But I am gonna ask that, and we can, tomorrow, and I can facilitate those answers and get them to you, right, Bob? And you can send them out, okay. So, good question. Any other questions on that?
The other thing the OFMA learned here in the last month, and I don't know if there's anybody here affected, they did like six desk audits on the 50,000 CARES money to see if it was compliant with whatever
Okay.
and there were no findings. Anybody involved in one of those? How did that go?
I didn't hear anything back.
Yeah. And that supposedly had to do with how it was used is what OFMA was saying, so.
Okay, I know on our end, we substantiated it, so we could support it, but we haven't been asked to do that,
No,
right?
we put it against the new building, so,
Yeah.
there was no problem, it was capital improvement.
Yeah. So, okay, so, to finish disbursement bit. You know, we all have to put footnotes with our financial statements, and the first time I presented on this, it was years ago, and it was, I don't remember who it was or what county it was, but two ladies in the front were talking about these footnotes, and it was so cute. It was before the session started, and the one lady just said, well, honey, it's just a little story about your fare. It was so cute. I just thought, oh, if only. But it's true, actually. It was just, I think of it, because when I write these things, they're painful to write sometimes, and I think, look, this is just a story about your fare. So that being said, for the societies that report on the cash receipt and disbursement basis, which I think is all of you in here except us, there is a COVID-19 footnote that you need to include in there. You can list it last in your footnotes. I didn't include it in here, but what I would recommend you do, you can go out to the Auditor of State's website and pull a county that has already been audited through COVID and just use theirs. You just go ahead and use, because go ahead and just copy and paste that sucker and put it on yours. It's standard language to go and put it on there. So if it's public record, so go out and use it. So for the cash receipts and disbursement basis, that's the only COVID-related footnote that I'm aware that you have to use. If you use accrual basis accounting, which is what we do, there's a lot more footnote disclosure surrounding, required footnote disclosure surrounding it. You have to report on your PPP loan, your EIDL, and all these provisions we've talked about. There are footnotes associated with that. For the cash receipt and disbursement basis, I don't believe that that's a requirement, but again, it doesn't hurt. The more you put in there and tell the little story about your fare, it's for your readers to understand your operations. So what I say, our footnotes are about 25 pages long, so if you need one, just go use ours. I mean, if you get in trouble, it's not my fault, I'm just saying. But I mean, but if there's a footnote out there that needs to be, it would be on ours, so.
They have shells, I mean.
They do.
It has that code with footnote in it.
Yeah, and that's right, there is a shell for it. But again, if there is a footnote out there that you think would be helpful, that you aren't required to do, you can put it in there, it doesn't hurt anything. It's just informational. So again, there is one, and I think it is in the shell. If it's not, just go look at somebody else's audit report and use theirs. I mean, we're all about sharing around here, so there's nothing unethical about that.
So question, why is Delaware still accounting by GAAP? Nobody else is.
So the question was, why does Delaware do GAAP and nobody else?
Advantage to your plan.
I can tell you exactly.
Dan's our treasurer, let him tell you.
It's to confirm, we got a tax that we get income from with the county.
Right.
And I have to balance with the county, and I have to do everything based on the year end and everything, so that's why I use the tools.
Yeah, and we started doing accrual basis even before me, so at least 20 or more
And then
years ago.
balancing our racing money,
Yeah.
so I have to balance it on the year. We don't settle the racing sometimes till March of the next
Yeah.
year.
And a lot of ours
And I have to
too.
go back into the year in which it was done.
Yeah, so I mean, since we operate every day of the year, I mean, it really out there is like a full run business. I mean, we have a full payroll all year round, and so we just, economically speaking, the decision was, it wasn't a requirement that we did it, but economically speaking, I think it was decided by the board years ago that we would do ours this way because it really shows I mean, we have a big balance sheet. It really shows the economics of everything that we have going on. So it's a personal choice. It's more cumbersome, I think, but it really, for me, since I'm a numbers person, it's a much more meaningful financial, I think. But yeah, it's just our choice to do that. Again, no requirement.
So doesn't the law technically say we're all supposed to be gapping, but there's a waiver in there that allows us to acknowledge out of it?
I don't know the answer to that.
I just wonder what the future is at long term. Why haven't they changed the law?
There are a lot of public entities that still
Yeah.
aren't GAAP, they're off BOA, they're lookalike GAAP statements, but they're
Right.
not.
Yeah.
And I mean, they're $1 million entities.
I mean, when I was a school board officer, I had to sign off my life because we weren't filing the gap, we were gonna file it in cash.
Yeah, I'm a fiscal officer for a small village, and we do
So I don't know, ours is just, from an economic standpoint, it really, it's more meaningful for us to make decisions off of and go off of, so. But it creates 25 pages of footnotes, so, you know, it's exciting.
Well, if we were receiving, dead taxes, we would file it any way they wanted.
We're not gonna kick a gift horn, we're gonna do whatever they tell us, right? Yeah. But I will, sorry, yes.
Did you say that footnote was on the Hinkle report already? When I haven't looked at the new Hinkle report.
Oh.
Michelle, yeah.
Footnote on there?
It's in the shell? Okay, it's in the shell. That wasn't where I found it, but if it's there, use that. That's probably what everybody did. So the question was, can the footnote be found, this COVID footnote be found in the shell on the Auditor of State's website? And the answer is yes. Yes, in the back.
Now, we took the ELD loan,
Uh-huh.
and when I reached out to the auditor, they told us to place it under the 3,300, so notes, not mortgage, because it wasn't a mortgage. So.
They wanted you to put it under 3,300?
3,300, sell notes.
Really?
They had me list as last year.
Did you get audited?
No, we have not, our audit came out, but
Okay.
that's the way the audit, and I kept the email from the
Yeah.
auditor from the state. To kind of put it at.
So if they want you to put it there, that would say you don't have to repay it. I mean, you have to, but.
I just.
Yeah, no, that's
The
interesting. Okay, so
auditor told me
3,300?
They didn't know where to stick it.
Of course, yeah.
They weren't sure, but they said this is where they was looked at.
Really? Okay, so.
Tomorrow.
Which one of those he was?
Sure, so what county are you with, sir?
Pickaway County.
Pickaway County, their EIDL money, when they reached out to the Auditor of State, the Auditor of State told them to put that on account 3,300, sale of notes.
Didn't make sense to me.
Okay, well, so again, yeah, so we opted to put ours under 3,800 mortgage because we have to repay it.
Well, their argument was it wasn't a mortgage, so, in theory.
Payable, but not for sale.
Okay, well, I'm gonna ask that question tomorrow and we'll,
That's why I'm bringing it.
yeah, no, I appreciate that, thank you. That's odd. Whatever. Okay, but thank you. I would have put it several places, but definitely not there. Okay, any other questions on that before we move on to, how to generate more revenue, non-COVID related at your fair? Okay. We'll do it on time. Okay. Okay, so this one, this is not a new concept, at all, but it did come up with the county, this past year that we worked through. And the concept really there is, and this is becoming much more popular just in practice in general, is you as a nonprofit organization, and we're all 501c3s, so we qualify to do this, receiving publicly traded stock, so let's use Amazon or Apple, pick your favorite stock, receiving that stock from somebody, a donor, that wants, rather than giving you cash, they want to donate to you or help the organization, and they want to do this in the form of stock. It needs to be publicly traded stock. That's a great way to increase revenue into your organization. And one of two things can happen there. You can receive the stock into your organization and hold it, so your ag society can now be the proud owners of Amazon stock. You can do that. Or typically what happens is you receive the stock and you turn around and sell it to generate the cash from it. And so that has, and typically people want to do this if I see this in my practice in one of two ways. Number one, well, the people have to be charitably minded, number one. If they are charitably minded and they want to donate to your organization, maybe they don't want to give you cash because maybe they don't have, maybe cash is cash and they want to hold on to their cash. But they have all of this, they have 1,000 shares of Amazon stock, which I didn't look at what it was trading at today, I forgot, I meant to. But they don't need it, they don't want it, so they're like, well, I'm gonna give you 50 shares of my Amazon stock. And whatever that can equate to potentially a significant value. And so if you have the mechanism to receive that, let's say they're with Charles Schwab, they can transfer that over to you, and you at your organization can either hold on to it and, let it ride and see if it appreciates, collect the dividends off of it or what have you, or normally speaking, you turn around and you sell it, you convert that to cash and go on your merry way. The way that you would go about doing that, your organization would need to set up an account with a financial advisor. So whether, I don't know, Fidelity, Charles Schwab, Morgan Stanley, pick your pick, whoever. Any financial advisory fund that could accept securities. And so basically how that just occurs, the person that wants to donate it to you contacts their financial advisor, and they just transfer it right over into your name. We just finished up year-end planning, and a lot of to take advantage of this really comes into play. One of the benefits that I've seen are people that work at, in Columbus, maybe the Central Ohio area, or maybe Cleveland area is a little different. You're working at a publicly traded company, so you're working at Wendy's or Honda, or I don't know, just pick another publicly traded company, and you're a longtime employee there, and people are just receiving all of these stock options, right? Their company is just giving them all of the stock as a form of a benefit, and so that to the recipient as the employee is potentially creating a large tax liability. So now they have 5,000 shares of Wendy's stock, and they're going to have to pay all this tax on it. And they're like, how can I lower this? Like, I don't know if I want all of this. Well, a great vehicle then is that you just come into all this stock, and you can give some of it away to your organization. You can donate that out to one of your favorite charities, whether it's your organization or, I don't know, pick one. So this occurred in another county, and it got facilitated, and it was great. And so it's just an idea. It's not hard to do, and it's a great way to potentially get another revenue stream into your organization. If you do have that, there is an acknowledgement letter that needs to go with it, just like if you receive any other type of charitable donation. On the acknowledgement letter, you need to provide the description of the stock, the shares received, and who the corporate entity was. So you would say that on December 31st, you received 100 shares of Amazon Inc. stock. What you do not put on there is the value of what you received. The recipient of the gift, if it is something other than cash, if you receive a gift or a donation that is something other than cash, you as the recipient do not put what the value is. You do not do that. That is the responsibility of the donor, the person that gives it to you, to determine what that fair market value is and how they treat that on theirs. Your responsibility is to send them a letter acknowledging that you received it, what it was, and when you got it. And then the other thing that is crucial here, and I know I have put this in every presentation that has charitable giving in it, you have to put a footnote in there, or you have to put a sentence in your acknowledgement letter that indicates that no goods or services were received for this gift. If you don't do that, if you don't do that, then the person that gave you that money is not allowed to take that deduction. An example of this, several years ago, there was a minister, I think a Presbyterian minister, that their church was doing a capital campaign or something, and so he and his spouse donated $25,000 to the capital campaign of the church for it. And the acknowledgement letter that was received back from the church did not have that sentence in there, and the IRS disallowed the deduction. So it's and you can't retroactively go back like, oops, let me go back and post-date that letter or predate that letter, whatever. So it needs to be a contemporaneous document. So if you haven't, whether it's cash or not cash, if no goods or services have been received for the receipt of a donation, you have to have that sentence in there, because if you don't, then the recipient could be at risk of not being able to take that deduction. On $100, that might not be a big deal, but on $100,000, that's a pretty big deal. I'd be a little mad if I gave you that money and if we didn't account for it correctly. So again, taking receipt of stock is a really easy, a nice revenue stream. You can do it with vehicles too. We're experiencing that at our fair right now. The requirements for that are a little more. I didn't put those in here. It's a little more cumbersome. But receiving those things and turning them into cash is a nice alternative from just strictly hidden cash. Does anybody have any questions on that? Okay. And my last slide, which I was hoping was gonna fill up maybe like 15 minutes of time, were updates from Washington under the current, Build Back Better plan, which is the Biden tax bill that's getting tossed around. Currently, it's sitting in the Senate, I believe, and the Congress came back from recess this week, so they said that they would be, taking action on this early in 2022. As of today, there hasn't been. So there's so much in there, and I attended a webinar a couple months ago, and of all the provisions in there, it was very helpful. He went through the provisions and he likened it to cold, warm, and hot. So most of the provisions got a cold or a warm, meaning they're probably not gonna go anywhere. There was like one hot provision and it's not really even applicable. So I don't even think there's anything to throw out there that's really of any use, because I don't even know if it's gonna stick. But a lot of the things that were in there that originally seemed to be taxpayer not friendly, at least this guy was indicating they were getting the cold or the warm feature. So not looking for that to change. So, I was thinking, certainly, hopefully in the next couple months, we'll have one, so maybe this will be a good topic for next year's, someone to present for next year's convention. Throw that in there. So that's all I have. Here's my contact information. Part of the benefit you receive from coming to these is you get the assistance of the presenter. So if you have any questions, feel free to, and I can hang around too to help. Yes, in the back.
I have a question. Do you have any information on the submission process for, the Ohio capital budget?
The question is information on the submission process for the Ohio capital budget.
So we got a notification from our county administrator that, our industry are represented for the types of eligible projects, 10 eligible projects list, and we are, like, agricultural societies are on that list.
It's a biennial thing.
You need to talk to your state representative.
It's
We're not
it's
exclusive
passed
to
in
their
the